Welcome to this week's video where I discuss what I believe will be important for investors to consider when they make their investment selections and choices over the next 5 to 10 business days. I want to talk about the recent jobs data, especially out of the US. Quite disappointing. I want to discuss oil and the effects that some of the recent news has on the price of oil and your investments. And finally, choppiness in the stock market. I think a lot of investors are feeling the markets are a little bit choppy these days, and I think this choppiness will continue over the course or the remainder for the rest of the year. Jobs data released this past week out of the United States and Canada were quite disappointing. We saw over 200,000 jobs lost here in our country, and down in the US, they grew jobs by about 266,000, much less than the 1 million jobs that many thought were going to be created. What does this mean for the market? Well, strangely enough, it actually was a positive for the market. You see, we tend to see at times that when we have negative data, this actually could be a positive, because what the government, central banks are looking at is they still will continue to supply or provide stimulus to the market. So what is negative is actually positive for the market. Lower rates for longer. Governments continuing to stimulate for longer. The market picked up on this, and we saw tech stocks, especially tech stocks, boom higher on Friday, followed by the rest of the market. So poor jobs data, poor economic data in general could mean some really positive things for the stock market action going forward. We've all seen the price of oil move significantly higher over the past few months. Price of oil now is sitting somewhere in the mid-60s WTI. A lot of people are talking about this type of environment that we're in right now as the booming 20s, very similar to the booming 20s. And obviously, the more we travel, the more we want to move around, get into our cars, take a long trip, especially out of the US, the more we're going to see the price of oil move higher. We've seen recently, unfortunately, a cyber attack on a major pipeline in the United States, which also should cause the price of oil to move up, at least in the short term. I think you could see the price of oil continue to move up. We've heard from places like Goldman Sachs that they could see, or they predict to see, oil somewhere as high as maybe $80. I'm not so sure about that. I've said recently that I think countries will start to produce more oil to combat these high prices. However, what I've been doing for my investors, and what maybe you should be considering, is maybe adding a little bit of oil to your portfolios. Look at some of the pipelines, whether it's an Enbridge or TransCanada pipeline or TC Energy, or maybe even a Kinder Morgan pipeline down in the US. I think these are ways that one could invest in this area more conservatively, earn a fantastic dividend, and a way to just gain some exposure into an area that seems to be gaining some momentum over the last few months. Many investors have talked to me recently, and they've said they've seen the markets a lot choppier than they've been, I guess, over the past 3 to 6 months. And my comment back was, expect this to continue for the remainder of this year and into next year. You see, I think the markets are starting to realize that interest rates are going to have to move higher to combat things such as higher inflation and a red-hot economy. We've seen the real estate market, both in the United States and here in Canada, really move higher. Average price of a home in Toronto, for example, is over $1 million now today. So I think the market is anticipating higher rates. We know higher rates brings choppiness. Stock market does not like higher interest rates, at least in the short term. Over the long term, I think the market will get used to it. And I think higher rates are actually necessary to sort of bring things down a little bit, cool things off. But expect choppiness to continue until a new catalyst emerges. Perhaps it'll come out of Europe. Perhaps some of these countries in Europe will start to open up their economies, start to open up to travel and other things. So I look for the market to be searching for a new catalyst going forward. Perhaps it'll come out of Canada, Europe, Asia. Who knows where that next catalyst will be? Until then, I think the US will continue to lead, but look for choppy markets to persist.